of presenting here, but mostly we're going to be looking at charts, and I hope you're okay with that. It's going to be a little bit of a different take on things. So that's what we're going to do. I trade a little bit differently than a lot of the folks that presented today. A lot of folks presenting today like to sit in front of their computers and they trade directional moves, whether it be on, commodities or stocks or indexes or ETFs, futures or options. And I like to actually set up my option trades, and I spend a lot of time planning them in advance, such that they'll just keep paying me income on every third Friday of the month. Do you guys understand what's so special about the third Friday of the month? The third Friday of the month, of course, is when options expire every month. And so, you can definitely leverage options and trade the underlying symbol directionally with leveraged options. You can get really complex and you can trade options based on their implied volatility changing. That's the buying and selling pressure of options that comes with like people's uncertainty and people's confidence in the markets, right? Because options are ultimately a hedging instrument, right? Big traders use them to hedge their risk. So when big traders feel that they are a little bit uncertain, they'll buy options to hedge their risks on their underlying positions, and that causes the price to go up. So you can actually trade the fear and the confidence in the market. But the way I like to do it is a little bit more, disciplined, or some people refer to it as lazy. I like to pay, profit on the fact that options are expiring assets. So let's go through this, because first thing I'm going to do is I'm going to show you this. I'm going to come back and I'm going to show you this again at the end, but these are the symbols. And again, I'm going to show you at the end once you have a better idea, because if you look up some of these symbols right now, some of you will say these are ugly performing symbols. If you're a technical analysis person, you'll say, oh my goodness, how is he making money on these symbols? So let's go through a couple of concepts. First, we have to understand about compounding, right? And so you've seen this a bazillion times, I'm sure. If somebody asked you, do you want to take a $50,000, payout right now, or would you rather take a penny that doubles every day for a month? Which one would you like to do? Think about that a second, because I'm going to go through the penny. 50,000 is pretty straightforward, right? I said I do an electronic deposit into your account, 50 grand, it's up and running. If we do the penny, don't forget there is some involvement, right? You have to be active to make this penny double. But if you double it every day, at the end of a week, you'll have a whopping 64 cents. So you might say to yourself, oh crap, I should have taken the $50,000, because I just put in a week of my life of focusing on the strategy to double this, and I got 64 cents. But if I keep going, right, about a third of the way through the month, I've got $5.12, still questioning if I made the right decision. But then if I keep going, 2 weeks into the month, I've got a whopping $82. Again, I've put in all this effort to learn this strategy, how to double my income, double my money every month, whatever it is, double my money every day. And I've only got $81.92. So again, maybe I should have taken the payout for the $50,000, but about halfway through the month, I've got $163.84. All right, about 3 weeks. The month is about 3/4 of the way over, and now I'm starting to get some value. I had to work a good 3/4 of the month, but now I've got $10,485. Still only 1/5 of that $50,000. But as you see, about 24 days in, I finally beat that $50,000. And it's in that last week of the month. And if I took the penny, I'd wind up with $21,474,836.48, which is way more than $50,000. And that's the importance of compound interest. But what's interesting, if I go back, a lot of folks have what I call shiny object syndrome. And if they don't see instant gratification in their investing right from the get-go, they won't stick to it. How many of you have ever heard of somebody who jumps from, crypto to this, to that, and they're always finding the next shiny object? the key to being a very successful trader or investor is finding what strategy not only appeals to you, but also is one that fits in not your future lifestyle, but your current lifestyle, right? This fits perfectly in my lifestyle because I'm more of a kind of nonchalant investor that doesn't want to rely so much on the timing of the market and having to be there, whether it be at midnight for some of the Forex type trades or having to be, because I have a life on my own, right? I just had a newborn back on October 31st. Yeah, she's a Halloween baby. And so I like to spend as much time with her. Plus, I've got all these hobbies. You know, I'm in my late 40s. And if you can believe it, about 4 years ago, I decided to do what I wanted to do as a kid and start learning how to be a trapeze performer, run away and join the circus. So I got things to do. So I don't want to be sitting and babysitting my computer all day. When I left my job in 2005, I worked for Hewlett Packard. I was a marketing executive for Hewlett Packard. When I left that job in 2005, the last thing I wanted to do was replace it with another job where I had to put 60 hours a week into it or whatever, effort I had. I wanted something very mellow. And when I was, doing my options trading, I started options trading in 1997. I learned that if I leverage the different, effects that options have, options can profit in so many different directions. And so long as I stuck with it, I can compound my income, right? Here's a really good graph, and I'm going to come back to this graph towards the end of the presentation, but I want you to get this solid in your mind. I especially want you to pay attention to this line right here. This is the break-even line. And so a lot of the trades that I do, in fact, this is an actual trade, it has a trade zone, and you'll see as time goes on, whether the trade zone gets violated to the bottom or to the top, it still profits. In fact, once your position gets past 5 months, it doesn't matter if the underlying symbol goes against you or go for you because the difference is very little. I'll show you some examples of that. So here's what I do, right? I focus on earning 6% on my money every month. Now I make a lot more than that. I actually make more like somewhere between 10 and 15% every month, but I focus on 6%, right? If you aim for the moon, you might actually get to the stars. And if I focus on just that 6% and meet that minimum return on my portfolio every month, my portfolio doubles every year. So what does that mean? That means if I start with $1,000 portfolio, and a lot of folks who work with me start with as little as $1,000, you could have that much in 12 months. You could have $4,048 in 2 years, about $33,000 in 5 years. And in 10 years, you're a bona fide millionaire. But even better, if you grow your portfolio to $100,000, then every year you're pulling in $101,219.65. And that's what I focus on because that's paying you more with just a few minutes of time every day, every week than the average white collar job that you could have, right? And those jobs, a salaried position, is where you're working 60 hours per week. I am not working anywhere near 60 hours per week. The average salaried white collar job where you work between 50 and 60 hours per week in the US pays $87,000. Here, I'm letting my money work for you. So what am I doing with options? It's called theta decay. I'm selling theta decay optimized option premium. In other words, I'm using the fact that options are wasting assets. I'm profiting on time passing by. Let me make sure you're paying attention here. I just want to, through each piece of this process, make sure that we've got comprehension going on. So what are the minimum returns that I'm targeting every month on my portfolio to more than double my money annually? Is it 0.5%, 1.5%, 5, 6, or 10%? What am I focusing on every month? Go ahead and type it into the chat if you want. Okay, I see some answers coming in. I said 6%. And so that's where we're targeting, right? If we make more than that, great. In fact, people in my program that I'm monitoring. So I have part of my program where I'm actually monitoring some of the investors. They're making close to what I'm making, 10 to 15%. And if you make 10 to 15%, it means you're doubling your portfolio every 5 months. But again, target 6%, double your money every year. Now, aren't options risky, right? Well, what's good is if you think about people who trade Forex or stocks or crypto or commodities, ETFs, indexes, they pretty much only know how to make the money if the underlying symbol goes up. Some of them know how to make money if the underlying symbol goes down, right? You're either going long or you're going short. With options, you can make money also. You can make money when it goes up or down, but you can also make money when the underlying symbol goes sideways. And if you pull up some of those tickers that I showed you in the beginning, we'll come back and look at that list in a couple minutes. Most of them are going sideways because you can also make money just by time passing by. And like I hinted, some really engaged option traders make money based on the fear and confidence in the market. So options have all these facets. In fact, mathematicians have figured out that using different combinations of option strategies, you could actually profit on the market 27 different ways versus just 1 or 2 ways. That's why we like derivatives. That's like why we like options. That's why Anka likes futures, right? Derivatives have all these interesting intricacies to them that allow you to optimize them based on how you select them. You might be also asking, now you're getting into this complex subject of options. What are they really? And as I hinted, they're a derivative. They're typically bought and sold to hedge against risk, right? That's how the big money investors, the fund traders out there, that's how they typically use them. But that's not how I'm using them. I'm using their premium to generate an ongoing income for myself. So what the heck does that mean? By the way, could you type into the chat section if you've heard of me before, if you've seen my presentation before, because I can go past these slides and save us some time. Have you guys heard of me before? Say yes or no. Just type it into the chat for me. Okay, we got a couple of yeses. We got a couple of no's. First of all, you can check me out at all these different links, right? You could even phone us here at Trading Trainer. There's our phone number, YouTube, podcast, Facebook, Twitter, articles, white papers, contact us. If you do go to any of my socials, please take a moment and subscribe. I'd love to have you. We have a Friday YouTube show that we do every week. Once a month, I partner with another trader and we go through different, again, on the YouTube show, it's Tuesday mornings. So definitely get involved with my socials. It's just a free thing to do if you're interested. And if you're interested in having me, just have a chat with me, give me a phone call. I founded a company called Trading Trainer. As I mentioned, a lot of folks are call me the disciplined options trader. I think they, like I said, I think they might call me the laziest option trader. I like to think of myself as being efficient because what I like to do is I like to minimize my risk while maximizing my reward on every position I take. But more importantly, I like to minimize the amount of effort that I need to put into these trades, right? I've been doing this since 1997. I've been working with my participants since 2002. I have an ebook that everybody's downloaded. I have a home study course that you find on people's shelves. I have this foundation that I started where I put a lot of my free time. These are historically underserved inner city kids that I take off the street and teach them how to invest. Maybe you've heard of them, heard of my story. But let's get back to the topic at hand. I want to stay to the time limit that David gave me. I'm focusing on 4 simple transactions, right? I'm writing some covered calls. I'm writing some covered puts. A lot of folks have heard of covered calls, but they don't know much about covered puts. That's why I'm flipping the covered call upside down. I like to write covered calls actually against leaps. This is how you can supercharge your covered call writing. These are called bull call diagonal debit spreads. And I do a particular variant of those bull call diagonal debit spreads that make analysis simple. I also like to write covered puts against leaps. These are called bear put diagonal debit spreads. And if you're taking notes, which I hope you are, please note that the covered calls, the bull call diagonal debit spreads, and the bear put diagonal debit spreads, those are all cash trades. That means you can do them if you only have a cash account. If you guys are trading in your IRAs or in your RRSPs, more than likely you only have the ability to do cash trades. Covered puts, because you have to start, the position by shorting the underlying symbol, it does require a margin account. So please take a note of that. What's nice, just very quick, is this over here, the covered put against a leap, the bear put diagonal debit spread, is a variation of this trade. So if you don't have a margin account, this is a great way to have the same effect with a cash account. So put that in your notes. So let's talk about, I keep throwing this buzzword around called option premium. If you ever look up an option price, like for instance, if I bring over my TD Ameritrade Thinkorswim account here, I've got Huntington Bank up in front of me. If I pull the option chain up, you'll notice that you've got a bid and an ask price for every option. The halfway point between the bid and the ask is called the mark price. And you'll notice that the mark price, this 87.5 cents, consists of a little bit of intrinsic value, 52 cents, and a little bit of extrinsic value. Another name for intrinsic value is in the money value, right? And you'll notice when the option is not in the money, when it's at the money or out of the money, the intrinsic value is 0. The extrinsic value is what's left over, right? The extrinsic value is that emotional component. It's also called time value. I hate that name because it has so much more in it than time. So I call it the premium value, and a lot of people do call it the premium value. So intrinsic, extrinsic, otherwise known as in the money value, premium value. And if you take any option price, it's going to be a combination of in the money and premium value. So what do? I focus on selling that premium value. Let's go through an example. As of the close today, Ford was trading at $19.98. I could buy some Ford stock, and then I can sell back the February 18th. This is the third Friday of February, $20 call, and I'd immediately get $1.26 back. Now, options are sold in lots of 100. So you'd have to buy 100 shares of Ford, and then you sell back one contract. And because they're sold in lots of 100, I'd get that rebate or that discount on the underlying symbol in the form of $126, right? And that's for every option contract I sell. I call it an instant dividend. It's a discount on the underlying symbol. And this $1.26, the value of that option is going to decay away with time like an expiring coupon. That expiration date is critical, right? So let's go through some examples. What happens if Ford winds up closing above $20 on February 18th? Well, I paid $19.98 for the Ford stock. I get the $20 back for having it go above $20. I get exercised on my option. They call me out, so I make 2 cents. But I also got to keep the $1.26. So I made basically $1.28. Now, I'm not factoring in commissions here. You have to factor in your commissions, but I'm just showing you an example. So $1.28 of total profit, or a 6.9% ROI. Remember, I'm focusing on 6% ROI, so this would do better than that, right? But what if Ford is flat by February 18th? This is actually what I really like, is if it's flat, because I pay the $19.98 for the Ford stock. I get the $1.26. The $1.26 expires worthless, which means I get to keep that $1.26 that I sold. I made $1.26 total profit to date, 6.7% ROI, and I get to do it again. I wind up keeping the Ford stock, and I do it again and again and again. And again, I told you this is the ideal state because it requires very little effort. I sell one option per month, and I'm guaranteeing this ongoing income, and the Ford stock just stays in my portfolio until it gets exercised. But a lot of people know about cover calls, and they say, well, what happens, AJ, if Ford drops by February 18th? Now, I'm going to show you in a little bit how I even reduce my risk on reward to almost nil. But even built into the strategy is what I call a profit buffer, right? Because we make that $1.26, Ford has to go below the break-even price of now $18.72 for this trade to go into the red. So I have this now buffer built into Ford stock. But like I said, I do an extra step, which even reduces the risk to almost nothing, the risk on reward to almost nothing. And I'll show you that in a moment. So I can show you some examples of this, but I actually want to show you on some of the tickers in our watch list. So I'm going to continue on with the presentation just to make sure you got it all down. So please take a bunch of notes, and then we're going to follow up on the end on real world examples so I can give you some ideas what I'm doing with my watch list. Is that fair? If so, just type a yes into the chat section. I hope I'm not making people fall asleep here. David's going to have you up for a few more hours, so you better stay awake. Good, good, good. So think about this question. When I told you about selling option premium, what does that create? And I want you to answer all that apply. Is it an instant dividend? Is it a discount on a security? Is it a profit buffer, or is it an expiring coupon? What do you think? If you answered all of them, you're absolutely right. So now I'm going to ask you a question that's going to get more complicated as we go. I'm watching the time. How can we lower our investment, increase our returns, and even convert a margin trade into a cash trade? What do you think here? Now, I'm asking you to guess because I haven't told you yet, but is it selling out in time options? Or should we replace the security with some options trading at parity? Should we give up and buy mutual funds? Or is what I'm talking about not even possible? What do you think? Which one of those is the right answer? Okay, I see some answers coming in on the chat section. I don't want to sell out in time options. The reason why I don't want to sell out in time options is because when I sell an option, I get put under an obligation to the buyer. That's what I get for getting that little bit of instant dividend, is I have to be put under an obligation till the expiration date. And the payback for selling out in time options versus the amount of time I'm under that obligation is not worth it, right? I get added another 30 days or whatever, and I don't get much more incremental income out of selling out in time options. No, if you answered B, you're absolutely right. I want to replace that underlying stock. I'll use a little bit of leverage, and I'm going to use an option trading at parity. That makes it very easy to analyze. So you might be saying, what the heck is this term, options trading at parity? Well, option premium is the most when the option is at the money. That's why we sell near-term at the money options. But when we're substituting options, we want to go deep enough on the money so the option has very little premium. We don't want it to have premium. We want it to have mostly in the money value. Why? Because then it's going to act like the underlying symbol. It's going to behave like if the underlying symbol moves $1, so will my deep in the money option move $1, but it's going to do it at a cheaper price. So I'm using, in this case, I'm using a different option strategy in order to leverage. I'm going to go deep enough in the money. I'm going to have that one-to-one comparison. So if I have an option that's deep enough in the money, I still have to worry about its expiration date. I don't have to worry about its expiration date because now that I'm so deep in the money, very little premium will be influenced by time passing by. No, I have to worry about this back month option disappearing on me before I've collected as many months of income against it, right? So how far out should I go? Well, I want to go far enough out in time so that I can collect as many premiums as possible. And I'll tell you, just statistically from the program participants, I've been running this premium selling program since 2007. I also teach folks how to be full-time option traders. That's my flagship program. But my premium selling program is pretty much the bread and butter now of what we do, because so many people are interested in not being full-time option traders, but being more like kind of let their investment portfolio work for them on the side. From their portfolios, the average position goes for 5 months. Now that's if you look at the bell curve, it's a very flat bell curve. Some positions go longer than 8 months and some positions only last 2 months or less. But 5 months is what we target. But because we know that some positions, go out as much as 8 months, that's what we try to do. We try to have our back month option last at least 8 months. Now, we like liquidity as well. Some of you who are familiar with options might know that if you get into some of these options, there's nobody trading them. So we need some liquidity. And so oftentimes we'll go and we'll find a leap. A leap is a option that's been around for a while and people have been trading, and they expire every January of the year. So for instance, for many of the positions that I want to do substitutes on, I'll use a 2023 leap, the option that's going to expire next January 2023. That gives me plenty of time to make income off of this thing, and it has some liquidity behind it. So here's an example, Ford. Now, Ford is a heavily traded symbol. So I could use the Ford stock that we used in the previous example, or I could go, now I'm not going all the way out to the leap because it turns out that the September $10 call is deep enough in the money and it's far enough out in time and it has a ton of liquidity. And that's just because Ford is traded by everybody and their brother. So I could either pay $19.98 for Ford stock, or I could have something that behaves like Ford stock and pay just about half the price, right? In this case, if you analyze that option I selected, it's got 98.2% of its value as in the money value that operates dollar for dollar with Ford stock, and only 1.8% is extrinsic value. So for the most part, it is trading at parity. So if we take that Ford stock, that Ford back month option, that option substitute, I pay $10.03. I get my $1.26 rebate or instant dividend off by selling back the $20 call. Remember, everything is sold in lots of 100. So for every contract I do, I get that instant dividend of $126. Now, if Ford closes above $20 on February 18th, I have to make sure I exercise the back month option. So I get the $20 from the front month, I exercise the back month, and I wind up getting the difference. So the difference between 20 and 10 is 10. So in this case, I actually paid $10.03. I only get $10 back. So I actually have a small loss of 3 cents. But don't forget, I collected $1.26 up front. So I get $1.23 of profit. And because I spent a lot less on this trade, I'm walking away with 14% ROI. Now, what happens if Ford is flat? Again, this is the ideal case because I'll keep trading it over and over as long as I can. Pay $10.03, make my $1.26. It expires worthless, which means I get to keep the $1.26. I'm going to do it again and again and again. And I'm so far 14.4% ROI so far. Starting to like this? Now, of course, if Ford drops by February 18th, I spend the $10.03. I get that $1.26. I've got a profit buffer. Don't forget, I'm going to show you in a couple seconds how you can actually reduce the risk even further. But this back month option would have to dip all the way down to $8.77 built into this strategy for us to have it go into the red. Otherwise, it's in the black. So again, I want to emphasize, if I focus on that 6%, my investment more than doubles every year. All right. So we talked about selling premium. We used the covered call example. I didn't even delve into the covered put example, but we can if we have time. We also talked about how we can substitute, instead of using the underlying symbol, we can actually use a back month option. We talked about as well, if you use the back month option on the covered put, it becomes a cash trade, which benefits those of us who are using our IRA accounts to get the tax benefits of doing this strategy. Now we want to hit the topic of how can we drastically reduce our risk on return. Should we sell half as much option premium? Should we sell out in time options? Should we collar the investment by marrying a protective option? Or is reducing the risk on return not even possible? I already see the answers coming in the chat area. If you said collar the investment by marrying a protective option, I'm right in line with you. So I'm going to show you this graph, but I'm actually going to pull over. Let's see if I've got it here. I'm going to pull over some examples. These are some trades I've done not too long ago. Let's look at some of these. First of all, here's an example of Huntington Bank, where I bought 700 shares of the stock. I sold back 7 contracts of the options for 75 cents. I got exercised. It was the $16 call. So this was a very quick 1-month trade, and I walked away very easily with 5.2% ROI. Here's one on Pulte Home. Let me zoom in for you. Instead of buying the stock, I went ahead and bought that back month call. I spent $19.30 per share. I got $1 credit. Again, I got exercised. So my back month option was the $30 strike price. My front month option was the $51 strike price. So when I got exercised, I got to keep the difference, $21. And this was a return on investment of 13.8%. Again, just a very quick 1-month trade. And you'll notice, some of you who have a keen eye, I'm not doing both positions at the same time. I'm legging into these positions, which means I do one transaction, and then maybe a week or two later, I do a second transaction, and then I wait for the third Friday of the month. Talk about easy. I'm not day trading. I don't have to nail my entry dates or times. I just come in and I'll do a trade when it looks like the position is doing what's called a retracement or a reversal within its channel. Got some Delta Airlines, but I want to show you this one on PAAS, and that's on the watch list, Pan American Silver. And you notice I've been running this trade for months. I started this all the way back in 2020, and this position is still in full effect. That's how cool. Sometimes you get one of these. It's very rare. But I started off buying 600 shares of stock. Notice what I did here. That was on August 26th. On September 1st, not only did I sell the premium, but I also bought a protective option. Now, I bought a protective option, write this down, that was about 3 to 5 months out. So you'll notice it's August, September 1st. I sold the near-term option September 18th, but then I bought a protective option that didn't expire until January, 3 to 5 months out. And I bought that strike price down near where I would want my risk to stop. So in this case, $34. Look what happened. On the third Friday of the month, my $1.76 expired worthless, so I got to keep the $1.76. And a couple days later, when I no longer needed to have this protective option in place because I didn't have premium sold, I was able to sell back the protective option for more than I made. Check that out. In addition to making money on the premium, I also have this secondary trade going that not only does it provide me protection during the days that I need it from September 1st through September 24th, but when I didn't need it anymore, because of the way I purchased it and sold it, I was able to make an additional frosting on the cake profit there. And I did it over and over again. Look, on October 1st, I sold my premium, bought my protection. The premium wound up expiring worthless on the third Friday of the month. And I sold back the protection. This time I made 61 cents per share on just selling back the premium. $1.47 on selling the premium itself, 61 cents by rolling out the insurance. And I just do that every month. One day a month, I'll sell my premium. I'll buy my protection. Then I'll wait for the third Friday of the month. I'll either get exercised or it winds up expiring worthless. Then I'll look for an opportunity to sell my insurance back and then rinse and repeat. I'm doing 2 days of trading a month. I'm not day trading. I'm not sitting in front of my computer. I'm doing 2 days of day trading per month. Does that make sense? So the key here, this is that position. This is just the first 7 months. Here's that break-even price. Let me bring back the spreadsheet one more time so you can see something. I forgot to point this out. After that first month, before I started the second month, notice that my cost basis was now down after I sold back that option at $31.86. That's my new break-even price after collecting the credit on selling the premium and selling back my insurance for more than I paid for it. Remember, I'm protecting this trade down to $34. So my break-even price is now lower than where I'm protecting my trade. And that's this bottom line. This bottom line shows that after the first month, I'm now in what's called a risk-free trade. If I get exercised out of the trade, if I actually have to use my protective option, I wind up making money in that case, as well as if the trade goes my way. As long as I stay in the channel, the trade just continues month in and month out. But if it goes out either side, heck, that's great. I don't care whether the trade goes against me. A lot of people are like, well, what happens if the trade goes against you? There's only a small amount of time right in the beginning where if the trade goes against you, you might suffer just the minimal of loss. But otherwise, the trade quickly becomes a risk-free trade. Does that make sense? In other words, at 5 months, which is the average time that these trades last, I'm guaranteeing myself 65% if it's exercised, 50% if the underlying goes against me. That's ROI, folks. And here's the key. This is how long it takes for the position to become risk-free. So imagine if you have your whole portfolio, however big your portfolio is, invested in these positions, and just once or twice a month coming in and doing a maintenance trade on it, and then just following it as it accrues and compounds like that penny did. All right. What do we have when our break-even price is less than our protective bailout price? This is a review. Do we have a risk-free trade? Is it a losing trade? Too much complexity? A pipe dream? What do you guys think? If you said a risk-free investment, you're starting to get the idea. Now, again, the key thing that I'm doing here is through my optimization and selecting of options, a lot of people will protect their trade the way that I protect their trade, but they'll use a different option and they'll just have it be a loss center to their trade rather than a profit center. What I've done here is I've shown you how you can make money on not only selling the premium every month, but also by rolling out your protective option. Not only does that protective option protect you when it has to, but by picking the correct option, you can actually turn that into a secondary income source or a profit center for the economics of your position. All right, so let's review these 3 steps, and then we'll talk about actual trades going on. You're going to buy or short an underlying security, depending on whether you're going to be doing a call trade or a put trade. Or if you don't want to do the underlying security, you could buy a substitute option trading at parity. And again, the cool thing about that is there's no shorting involved, because when you buy a back month put, it does move dollar for dollar with the underlying symbol, but it's indirect. So for instance, if the underlying symbol drops $1, the back month put increases by $1. So it turns your margin trade into a cash trade, no shorting necessary. So that's step 1. Step 2, we're going to sell near-term at-the-money options for their premium value. Going to collect that instant dividend and profit buffer. And we're going to collar with a married option that is about 3 to 6 months out in expiration to protect our investment. Then we're going to wait. We're going to let the position set up in 1 and 2 either expire worthless, so I can do it again, or get exercised. And then I'm going to simply roll out my married option. Again, 1 or 2 transactions per month. And again, you noticed by the dates of the positions I showed you that I leg into these positions. So for instance, if I'm thinking about a covered call position, I would start at the bottom of a sideways, boring looking symbol. And I would either buy the underlying or the call option trading at parity. I'd put a stop loss order like you would in any trade in order to protect myself. And then I'd wait for it to top out. That's when I'd sell that near-term call option, buy that 3 to 6 month out put option. I'd wait. And on the 3rd Friday of the month, or, you could trade weekly options. That the weekly options expire every Friday. But on the 3rd Friday of the month, if you're selling monthly options, you get your payout from the premium selling, and then you wait for the risk to end, meaning you're no longer in range contraction. You're now reversing back into range expansion, and you'll roll out your protective option. Rinse and repeat, rinse and repeat. Or if you happen to be starting at the top, you don't have to wait for the symbol to move to the bottom. Here's where I could either short the underlying symbol or buy a put option trading at parity, put in place a bailout order, a buy to close order just to protect my risk. Wait. And once I've bottomed, I'm going to sell a near-term put option, buy a 3 to 6 month out call option as protection. Let that put option expire worthless. Roll out the call option, rinse and repeat, rinse and repeat, rinse and repeat. Here we are. So let's take a look at some of these symbols, and let's just click through a few of them. And I want you to write them down. Lower price symbols. A lot of us have smaller portfolios, so lower price symbols are going to be where it's at. Ericsson, Pan American Silver, Huntington Bank Shares, Wendy's, Ruth's Hospitality Group. Some of you might like Ruth's Steakhouse, Rite Aid, the Silver ETF, Teva Pharmaceuticals, American Airlines, Delta Airlines, JetBlue Airways, Mattel, the toy company, Perion Networks, and United Microelectronics. I put asterisks by these because they have expiration. The difference between their strike prices, they're actually in a great place to trade right now, but sometimes these ones get a little challenging. Doesn't mean you can't at least forward test or paper trade these things to see if what I'm talking about even makes sense. Another one is TJX. That's TJ Maxx and Marshalls and Home Goods. Cisco Systems, General Electric, Pulte Homes. These are a little bit more expensive. But let's take a look at some of these. Like, for instance, Huntington Bank. Here's a 2-year chart. And you'd say this, oh my God, what a boring stock. And I say, oh my God, what an income generator, right? If I've got any sort of symbol that is going to be going sideways, that's the one that's going to make me a ton of effortless income. Huntington Bank Shares. How about we showed Pan American Silver? Even through a couple of down moves, our strategy works, right? You can sell wherever you've got range contraction is when you sell the premium and buy the protection. And whenever you have range expansion, you're going in the direction of your primary trade. You let that trade run unfettered, and you just oscillate between that. And so you can actually manage these positions through downtrends or uptrends. But again, if it's boring, if it's not in the headlines, if it simply is moving the way that it wants to move, those are the ones we like. We like ones that give dividends. In fact, we have 10 characteristics of symbols that we like. And in fact, all those symbols that I just listed on my slide, these guys, I'll show you where they come from. Built into our program, this is the members area of our web portal when people are part of our program. We have screeners. You'll notice over here, I have the main original screener. This one is for today. It already ran today. And then we have some beta screeners, beta picks 1. And we have beta picks 2. And every evening, our 3 screeners give us a whole bunch of candidates for us to check out. The other place we get candidates is we have a call that we do in our program every Thursday evening. And the actual participants, we have over 400 participants in our premium selling program right now. And they come and they give us the symbols that they've got their eye on. And we decide as a group, usually we have about somewhere between 75 and 100 people on the line every Thursday evening. We even started doing some afternoon calls for those folks that are in Europe. And they'll throw symbols at us, and we'll pick the best of the best during our workshops. And then we'll plan it out for everybody so that they can follow along, adjust it for their portfolio size, their risk appetite, and then we can all trade it together, right? So that's where a lot of these symbols on my January watch list have come from. Either our screeners in our program or even some of our community have contributed some of these candidates. Another area that I've got since I've been trading premium for almost 20 years now is they're just ones that come back. It turns out when you find a candidate to sell premium against, these are like long-term candidates. You'll form a relationship with that underlying symbol. And there might be periods where, you get exercised out of a position and maybe you don't go back in right away, but you'll find out that if you do this as long as I've been doing it, that some of the same boring ass symbols keep rotating back into your watch list and you just trade them over the years, right? One of the ones that's kind of gotten very expensive, you may want to go check this out, is Caterpillar, right? Caterpillar is up in the, you need to have a fairly large portfolio to sell premium against Caterpillar these days, but I've been trading Caterpillar for the last, 15 years. If I go back and even look at like a 10-year chart, you'll see these are monthly bars. You'll see periods where Caterpillar for years went boring sideways. And then you'll have these periods, something happens. Maybe there's a stimulus bill and, construction gets all sorts of like, build back better or whatever you want to call the infrastructure, and Caterpillar, skyrockets because everybody needs bulldozers. But for the most part, bulldozers are boring. And if it says boring against its name, guess who's interested? Me, because boring to me means ongoing income with little effort and almost no risk. After the first month of collecting premiums against these symbols, there's no risk. It becomes risk-free. Here's Ruth's Steakhouse. Check it out. I mean, again, if you're a directional trader, you'll say, oh my God, that's the ugliest looking symbol. If you're an options trader who knows how to sell premium, you'll say, this is money in the bank. That's Ruth. How about Wendy's? Wendy's is one I really like. I'm going to go to, let's look at a year. Think about it. Every time you're up here, you can sell your call premium. Every time you're down here, you're going to add to your position. Just go up and down, sell the premium, let it expire worthless, roll out your protection. Rinse and repeat, rinse and repeat. So I hope you take a second and you write down these symbols, because these are the symbols that I'm watching. I'm actually have plans to trade all these, and I'm paper trading them. What I like to do is I like to paper trade at least 10 symbols at a time with my plans that I've back tested. And I'll paper trade these 10 symbols, let them run for a month or two. And as you're watching them in real time, out of those 10 symbols, 2, maybe 3 of them will come to the top, and that you'll see these are the ones that would be so easy. And these are the ones that are guaranteeing me income, and you'll move them over to your real money portfolio. And before you know it, your whole portfolio, you know, it only takes somewhere between about 5 and maybe 10 positions to have a whole portfolio. My portfolio is up in 8 figures right now. So it doesn't matter whether your portfolio is as small as $800, which we've had folks join our program and do, or if your portfolio is up in 8 figures, right? It doesn't matter. You can scale this either way. No matter the size of your portfolio, it's going to be between about 5 and at the most maybe 15 positions that you have, and your whole portfolio will be on autopilot, right? All right, I have about 4 minutes left. So my question is how would you like to never miss a pick, minimize the amount of time you spend away from your loved ones or your loved passions, like maybe you want to go join the circus or travel or something like that, and have support whenever you need it? Because that's what it's really all about. It's about saving time, creating clarity, and of course, getting results. And so if it's okay, I'm going to spend the last few minutes David's given me to tell you a little bit about my materials, training, and tools to see if they might be a match. My program is definitely, this premium selling program is for someone who doesn't want to pay for multiple data subscriptions, wants everything they need in one place, doesn't want to miss any opportunities, wants to spend more time doing other things. And I think that that's really the key here. Doesn't want to do it all by themselves and would like some step-by-step instructions. They'd like to basically get consistent and reliable results. Here's a testimonial. Yeah, Charlene, she was awesome. She still is awesome. She was a teacher and she had taught for 29 years straight, started right out of college, and she got sick. It was cancer. She got ordered out of the classroom. She still had 13 years left to get her full retirement, her pension with the county. And she thought she was going to pass away, and she was totally peaceful about it. And then she got a miraculous recovery. Now that's here in the States. And many of you know about medical bills in the States. You know, a miraculous recovery also comes with having all these medical bills. She had no livable retirement. She wasn't going to be able to collect anything like Social Security for 10 years. So she got interested in the stock market, and the rest was history. I introduced her to this program. We call it the Instant Income Calendar program. She reads the daily table, finds the stock she's interested in. You guys have a jump start now because you have my January watch list. She follows the strategy set out for you, the strategy. And she recently made 14% by just spending about 15 minutes reading about the company, following the chart, and then waiting for expiration. So that's kind of cool. So what is this all worth to you? Think about it. I showed you a little bit about my web portal. You know, I showed you the beta picks, but we've also, I told you about, we've got premium selling tutorials. We've got the replays. We have a once a month lecture series. In fact, that once a month lecture series is tonight. So after I leave this call, I'll be going on and working with my members. We have the weekly workshop. We have the screeners. We have a place. This is the best part. Trading questions. So if you have a plan that you want to get vetted with me, you can just come over here to trading questions, and you can see here, it looks like an email, but it bypasses all of my spam filters. It comes directly to me, and you can attach your planning tools and say, hey, look this over before I do this, and I'll catch any sort of mistakes. And I do that for all of my users. So in addition to joining us on Thursdays, people will constantly be sending me their trading plans, and I'll tell them whether or not they missed a detail or not, or if they're good to go. It's kind of awesome. We got a great little community going on. So video tutorials, monthly live classes, screeners, planning tools, weekly, all of that good stuff, my trade reviews. So how much do you think that's all worth? There's also a double your money back guarantee. Now, I'm going to ask you to be part of this program for 6 months because that's how long it usually takes to get up and running and get your whole portfolio invested, right? I want you to get comfortable with the strategy. Then I want you to do what I do. because this is a long-term thing, right? So I want you to put in the 6 months. And after the 6 months, if you're not showing a profit on your portfolio, I'm going to take the money you pay for this program and I'm going to double it. And I've had this guarantee going since I started this program in 2007. In addition, I'm going to give you a free coaching session. A lot of people aren't sure when they get started with our program what they can expect and how to speed up, how to make the most of their efforts. So I want to give you one session with one of our coaches that'll talk about where you are, point A, where you want to be, point B, and what's the straightest line. So if you add in the double your money back guarantee and the bonus strategy session to everything else, what's that worth to you? Well, the price of our course is $597 for the 6 months. That's a flat fee. I'm not going to charge you. I'm not going to put you on any sort of subscriptions. It's a one-time fee. I can even put it into payments if you want. And because David frickin' rocks, tonight it's going to be $497 instead of $597. So I'm going to knock $100 off for tonight. And so the way you're going to do this is you're going to go to this link, optioninvesting.org/synergy. If you've got a mobile phone, you can just point it at the screen, that QR code, and then it's going to say $597. So put in the promo code. There's a place to put in the promo code for tonight. It's called 100DISC. It is case sensitive, so put in capital DISC. In fact, I do have a hot minute here. It's 6:58, so why don't I quickly, we'll see, maybe David will cut me off, but I'm going to try. I'm going to come over here and I'm going to type in optionsinvesting.org/synergy org. Make sure you're not doing clerical errors like I am. Is it option investing? It's option investing. Don't make it plural like I did. Let's try that one more time. optioninvesting.org/synergy. There it is. And as soon as this comes up, like we said, $597, find the promo code area down here at the bottom, put 100 DISC, all capital letters, apply, drops it down to $497. And if you're having any problems whatsoever, you can definitely give us a call here at Trading Trainer. We actually have people who will answer the phone. Or if...
Yeah, sorry, AJ, I'm going to have to cut you off.
Cut me off. I'm done.
All right. All right. Well, thank you.